Hello and welcome to this interview here on Money Paathshaala. Joining me today is one of India's finest equity minds, someone who has more than 2 decades of experience and has successfully managed wealth of hundreds of thousands of investors over his long journey. He holds the position of CEO and CIO, which is a very rare combination. He is currently with InCred Asset Management, but has worked across leading mutual funds and is now trying to build a new mutual fund house bottom up. Thank you very much, Mrinal Singh, for joining me. It's always a pleasure talking to you. Your Hindi is remarkable, but today we'll stick to English. But I would love to interview you in Hindi as well. I did once, and I found it quite amazing. But my first question to you, lots happening in the stock market since we last spoke. What is your current outlook as far as the equity market is concerned?
Thanks, Vivek, for giving us an opportunity to interact. It's always a pleasure to be able to talk to you. So, the equity markets, obviously they have to reflect upon the economy. They temporarily disconnect, but the good track. Let me talk about the good part first. The good part is our economy is on a good track. After a very long time, almost a decade, we are seeing capacity addition in the system, and high frequency data is clearly consistently pointing in that direction. I must mention data is particularly like import of capital goods, which is excellent data point, which basically means that capacity is being created in the system. We have also, after almost 10 years, started seeing credit demand in the system. Again, a very good lead indicator for CAPEX. Now, CAPEX, along with import of capital goods, demand for credit, and there have been incentives and schemes like PLI, which have catalyzed in the 13-14 sectors that they are applied to. So these are good signs on the economy. And obviously, market in one form or shape with some lag does reflect that. But then the market, as we stand today, almost at a 4 trillion listed market cap, we are no longer an unknown story in the global landscape. We are a very, very well-known economy. Our growth trajectory might be debated in terms of 6, 7, 8 or some number, but everybody knows that we are the fastest growing large economy in the world for the next 5 years, maybe 10 years, maybe beyond, which has also created a pull for investors. Now, the markets are obviously the way things have got constructed, and we must give credit to the regulator as well as others participants. The markets have been able to smoothly attract a lot of global FPI flows. It starts reflecting, and the data is obviously at a very high frequency share. And the biggest change that has happened in the landscape is in the last 5 to 10 years, the domestic savers have deployed large amount of their savings through largely mutual funds in the equity landscape or equity market. So we now have a very robust, I would say quality and quantity of monies trying to capture the growth potential that the Indian market offers. Now, having said that, a large portion of that money obviously tries to navigate through the options in the largest businesses. And that is what takes the limelight in the press. That is what kind of finds attention in the global scheme of things because they would like to be in the larger side of businesses. So we periodically see that, the markets remain, at least from a traditional valuation perspective, on a bit elevated side. Some bit of that elevation can be justified from the potential growth that would accrue. But a large portion of that can potentially be accommodating a huge amount of growth that could potentially come across. So I would say the real headline valuation of the broader markets to me looks like being on the steeper side. But then that statement would be, I would say, incomplete without mentioning that there are still pockets which look very interesting within that space, because what we look in the broader market valuation is largely things which are on an average. be it the Nifty or be it anything else, it's basically an average of 50 stocks, or Sensex has average of 30 stocks. It basically means there are 25 stocks beneath and 25 stocks above. So you have to, we are in a zone in the markets, and we've seen them multiple times in the past, where you have to do your work, be selective about what you want to buy based on your research and your assessment of how profits could pan out. And I think you are in for a reasonable return going ahead. A lazy way of investing, trying to replicate the market or doing something, just based on some wish and fancy, I don't think it's going to work. So you will see this question will remain unanswered for a variety of participants. But the reality is, that people who are serious about investing, who go in a methodical, research oriented way, will actually, with patience, display returns. People who are trying to just dump money in the market, trying to see that, okay, fine, we are also present, I don't think that would be a great way of or idea of making money in the market. So, long answer to your question, Vivek, but I hope it addresses.
No, wonderful. Mrinal, how are you seeing the mid cap and the small cap space? I mean, in number terms, it's a very big space. Going by the categorization of the market regulator, I mean, it's not a small handful of 10, 20 companies. It's a very big space as well. And where, as you said earlier, that, the headline indices numbers may not reflect the kind of growth we've seen there. But what is the valuations like at this point in that space? Are you finding good stories there to continue to pick?
Excellent question, Vivek. Actually, that is the hunting space for a classical investor. There are more than 5,000 listed stocks. Let's say I would say at least 3,000, more than 3,000 are potentially investable. The first 100 is the large cap, so let's put them aside. The next 150 is the mid cap. I mean, we can choose to put them aside as well. That actually still leaves more than 2,500 stocks for you to, explore upon or research upon or trying to unravel upon. So a small cap index in per se definition, let's say, has 250 stocks. I mean, imagine 250 trying to represent 2,500 plus stocks. So the index actually does not do justice to what that space is trying to offer. In contrast, let's look at large cap. Let's say the most widely tracked large cap index is Nifty, which has 50 stocks, and the large cap definition is 100 stocks. So it's a fair representation. You are representing 50% of those. So I would say that's a large and fair representation, and that to the top 50. Mid cap actually has an entire representation. Most mid caps, have 100, 150 stocks represented in their index. So that's, I would say, is fair representation. But in the small cap space, which in gone by era, 10, 15, 20 years ago, used to be mid and small cap space. But I would say the small cap space is the space which offers huge disparity. I mean, we find pockets which could potentially be skyrocketing valuations where things just don't make sense. And we find plethora of businesses which actually make a lot of sense. So from a perspective of filters of your template, I would say management, valuation, and business. No matter how you look at it, most investors actually try to take these three parameters in a template in some sequence of preference, plus some other, things like risk and all of that. So I would say in terms of valuation, you do find interesting names. You can run filters and a host of stocks will come across. Then the second parameter in terms of business quality or business ability, you have to do your research widely unresearched space. You have to do very classical way of things. You have to actually go down, see, meet management, if at all, vendors, maybe understand from their clients, make a calculated assumption about how this potential product or service that the business is going to go. And then the most difficult part, make an assessment of the management. Now, when a stock is small, not widely researched or not much is available, you have to do very classical things, pick up annual reports, see what they've been talking, what they've been doing, make an assessment from the ecosystem that they operate in, maybe the distribution, clients, competitors. So I would say you can choose to keep yourself amused by saying that small caps look expensive. But the reality is there can be no blanket statement to that space because there is such a huge disparity. For all-time high markets that we are roughly into, I still see very interesting businesses which might be much lower in the market cap, but who says you can't invest in them? You can put, if you think there is a great management, great product, and a great valuation, it's a matter of patience. But it requires a large amount and quantum of work to actually get to a conclusion that everything is great about it. But do you get it? Is it worth it? My answer is yes. So I would say we can look at the broader indices near all-time high and say small caps have moved up. But the reality is great small cap investing is the bedrock of alpha generation. So if you are a classical alpha investor, if you're a research oriented investor, I that is the space to be in. Why should you get bothered about where the small cap index is going? There are so many. I mean, my challenge is not to be able to have a judgment about is the small cap expensive or cheap. My challenge is actually to how do we go about ensuring that we do justice to such a large space. It requires manpower and time. So we have to be judicious about how we do that. We run some filters, make effort in that direction, try to figure out. It takes time, but it is definitely worth it. And my investing experience has clearly taught me the best ideas of multi-baggers in the double-digit category, we have always found a small cap progressing to a mid cap, maybe a large cap, or something of that sort. And there are classical traits of small cap investing in particular. In my experience, clearly management supersedes both valuation and business. So by far, if you get the management assessment right, and which is the most difficult part, and that is something that I'll keep for a separate discussion, Vivek. But if you get it right, valuations and business, you can only make sense of the valuation if you can really understand the business and the opportunity size well. But there is so much disruption happening in the economy. We are practically in the fourth industrial revolution where there are so many, we know it. There are things are going to look very different in terms of how consumers are going to consume, how education is going to be implanted, what kind of skills and capabilities are required for people tomorrow. I mean, is it not common sense to expect that there will be new enterprises that will actually make the mark? That is obviously true, but it requires to be ahead of time. It requires to put the hard work in, and it is worth. So that journey is enjoyable. Any investor true to his profession would love a journey like that. You can obviously choose to be invested into large cap. So there are perils associated in small cap, no doubt. Failure rates are higher, weak balance sheets can capitulate. We obviously see much higher volatility, but it does not mean that it is not rewarding. And it's an experienced and along with the research capabilities which can do justice to it. So I would not fall for particularly in the small cap space. First of all, there is no representation of that space. The index is just less than 1/10 of that space, so it doesn't represent that. It just shows these are the top 200 to 50 small caps, so that's what they are doing. But it does not end there. I mean, if I just say the top 100 large cap, next 150 mid cap, next 250 small cap, largest small cap, let's say, it just takes away 400 stocks. I mean, it still leaves 300,000 more stocks where you could potentially look. So I would say don't get swayed by headline valuation in small cap. Do bother about the headline valuation in large cap. Yes, you should. It's a fair representation. Small cap is very classical, very bottom up, very absolute oriented investing. And so if you're an investor of that variety who enjoys that journey, you obviously would love such a scenario. And that too, when the economy is turning, we are moving in a zone where manufacturing related growth propulsion is picking up. We are practically at the door of fourth industrial revolution, maybe AI, maybe IoT, maybe drones. We don't know. So many things are happening. Consumer behavior patterns post-COVID have completely changed. So much of it. And plus, there is clear incentive for MSME from the government. And there is more and more push for lending agencies to actually facilitate that capability. The environment has never been so supportive and good in the past. I can't remember when it was last so supportive for that space.
Mrinal, given the positive outlook for the next 5, 10, 15 years, if somebody were to invest at this point of time, so on the one hand, we have an elevated market, but at the same time, commentators like you are saying that probably the next 5, 10, 15 years, there is a lot more steam left in the Indian economy. So, should one do a lump sum at this time, or should one continue the SIP route, which has become very popular? What is your advice?
So again, a very, very relevant question, Vivek, and I would suggest a very pinpointed solution for it. If you are an investor who has access to investment advisory, you should consider lump sum or asset allocation framework along with an SIP, because you have access to advisory. So you might be able to, get your risk and financial goal assessed, and there might be a set of solutions that can be provided to you, because you have somebody who can guide you through. Okay, that you are under invested in equity, you might actually choose to have some allocation and then spread it out through SIP, or this kind of product is what suits you. But if you are a small saver who's actually not necessarily having access to advisory, I think SIP is a great way to go about it. So I would say, based on how you are in terms of a saver or an investor, I think you should choose the right kind of access to advisory would be a very good thing. And now the market has evolved into portfolio management services, AIFs, and mutual funds. So you might be having access to tailor-made solutions for your financial goal and risk. Advisor actually can suggest you on those lines, and it would be very good to have an advisor assess things for you and guide you well. In absence of that, I think SIP is a great method, and you should choose to target, even for people who are only doing SIP. You should choose to target a percentage of your saving going towards equity, and that SIP should actually not be a notional one, but a significant one and a long tenor one above that. Let's say most people have seen the largest bucket for SIPs in the 3-year tenor. I think it would be advisable for people, and we are a very young society. It would be advisable for people to look at 5 years and north. I have seen, and it is statistically established that the longer tenor you provide to your equity investments, the odds of you succeeding are incrementally in your favor. I mean, if you are a 10-year investor, you might have entered even at a wrong price, you will still make money. I mean, that is what time does to you. So for a society as young as ours, starting early using the SIP route, at some point you might be able to access advisory. That is something else, but don't miss out on the growth decade that India is offering. Starting valuations aren't great, but then that does not mean that there are no investable options. Equity is obviously a great way to capture the growth and be part of it. The markets will swing. There are various factors and risks that will play out, and that's a good thing. Don't look at it negatively. If markets just go one way, I mean, there won't be much returns to make. But I would say a swing is desirable because the volatility is an intermittent short-term phenomena. Use SIPs. In fact, if you think the markets are down, you can allocate even more outside SIPs. And make sure that when you are 40 or 45, a significant portion of your assets are part of the equity markets.
Mrinal, you did talk about manufacturing, especially in the SME space, as something that you see as a fourth industrial revolution. Other than that, what are the themes, not sectors necessarily, but themes that you are bullish on for the next 5, 10 years?
So there is something that I would say is staring at our face and people seemingly are ignoring it. And which is, I would say, the revival of rural India. Uh, the last 3 years, particularly COVID and beyond, have been very harsh on rural households. COVID impacted their revenues, or I would say their incomes, and inflation actually impacted their ability to spend. So we've seen that effect on across categories SKUs. So we've seen luxury car sales in terms of growth number outpacing entry level car sales. So has been the case with mobile phones. So has been the case with even juicer, mixer grinders, ACs, you name it, every product category. And that's very, very baffling. How, I mean, India pyramid is so broad. I mean, amongst the 300 million households, what are we talking? I mean, most of it is in middle income and lower income. So that is where the volumes are. So how can luxury cars outpace? That's a base effect, but the reality is that rural households were very badly impacted, or I would call it lower income households, even in an urban space, were badly impacted between COVID related income compression and inflation eating away their existing income. Now that is behind. We have seen every business which has a rural phase saw volumes either struggle or decline. But if you now look at earning commentaries, last 2 quarters and more confident now, amongst the best distributed businesses like Staples, I would say all of them are saying that rural has bottomed out. In fact, we are seeing growth. Global Unilever CFO said there is growth in rural. In today's economic times, Pepsi CA guys are saying that rural is the growth provider to us. We are 40% rural in our food products at least. So is a company like a Jyoti or a Dabur. I mean, you go on and on. And these are businesses which have the best rural footprint in India because they are in every nook and corner in every district in India. So they in a way represent the actually economic health of households in a very, very significant way because lower income plus lower priced SKUs. So it just shows up in their volumes. So we are going to see the revival of rural India. And that is not something that you can ignore. The higher ticket volumes in India are very minuscule. For example, the luxury car sales in India, all put together, is not even 60,000, wherein the overall car sales in India are in excess of 3 million. So that 60,000 growing at 10-20% actually is just a newspaper headline. It is not something which really moves the needle. That 3 million car sales growing by 5 or 10 or 15% actually moves the needle. So if rural picks up, which I'm very certain in the calendar year 24, we are talking about huge demand in terms of volume and a lot of capacity that has been created in the system in the last 1.5, 2 years and going ahead will actually, in my view, fall short because our rural base is really big and there will be a scramble. So all wise businesses and promoters would actually be scrambling to expand capacity because rural across the board is either bottomed out or has started showing growth data. So in my view, it's not that rural is a 6 months phenomena or something. No, it's a momentum that moves on when it picks up. Besides that, capex, and it is not very different from what I'm saying. When demand picks up, capex either is preempted or post demand. So we will see manufacturing capex. We will see services continue to grow, but that would be more export led. I'm not very bearish on US economic outlook either. I think recession, if at all it is there in US, might be short-lived or a slowdown at best. So there will be revival because the seeds are already sown for the, I would call what I mentioned as fourth industrial revolution, actually mean it more in the context of the West. Because between AI, between drones, between IoT and things like that, the entire way of communicating, consuming, and interacting is going to see a revival. AI can potentially impact every aspect of our living. So there is enough to invest money and I would say bandwidth, human capital into, and that itself will have a driver. But then in our case, manufacturing has been lagging, so we are going to see that revival. The signs are very clear. There is policy priority in that direction. Rural is going to show growth that will create demand and justify a lot of capacity creation plus show more. In terms of some sectors, I would say, some sectors have lagged behind. I would say healthcare being one of them. That's also very well placed. And I'm not saying pharma, I'm saying healthcare. So a lot of people tend to confuse. Healthcare is far broader than pharma. It includes diagnostics, insurance, hospitals, old age homes, anything related to nutrition or healthier way of life. So, and every economy has seen when per capita income grows from $2,000 to $5,000 and beyond, the largest allocation that a household does is between two, three key sectors, one of them being education, clearly, other being healthcare. At an average, it is seen that beyond the basic needs, the growth at which the household spend typically is 1.5 times the GDP growth. So healthcare is very well positioned. I think that is being undervalued by the system. I would say urban consumption, not now, but with a lag, because once all these things play out, urban consumption, discretionary in nature, it will always have its cycle. In the last 1 odd year, between the interest rates, inflation, and the flattish asset prices, we've seen urban inflation trickle down. But as things normalize, we will start seeing urban consumption also showing upticks, and tech and telecom. So I would say these are broader spaces or areas where I see clearly that we could see a 3 year, 5 year trajectory, which the market is as of now under appreciating. Rural being obviously a dominant one. And rural is a very large thing to say. A rural population might be, let's say, 65-70% of the nation. But in terms of volumes, it is almost 80% plus. So when the volumes pick up is when you really start seeing growth. A lot of people complain that, we see the markets going up, we don't see the growths around us. That's because you haven't seen the volumes moving up. Once rural picks up, you'll all of a sudden feel the heat of growth, irrespective of the market. You will see it around you that, yeah, things are flying off the shelf. Lower ticket SKUs are moving fast. There is innovation. Companies are starting to invest in that direction and things like those.
Absolute pleasure talking to you, Mrinal. Really appreciate your clarity of thought and sharing it with our viewers. Thank you so much for taking time out. I look forward to many more such conversations with you.
Thank you, Vivek. Pleasure is all ours. Thank you so much.